Hello and welcome to episode 317 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, we're back. We took a week off, but we're here. We made it.
We are back, and what was great, we had a couple of people actually write in and say, I hope you have a good time off and a good break, so which was quite nice actually. You were off for an entire week. I had a few days off. I even went to a theme park, which is something I obviously haven't done in a very long time, which was bizarrely enjoyable, even though we had to queue a bit, but queuing is almost a luxury these days, actually doing something that is not in your own house or garden. So no, I had a really good week off, come back full of energy. And the other thing that's been a massive positive is we've had Bronte start this week. So we've got yet another member of the Money to the Masses team, and people will over time get to know Bronte and see Bronte, and hopefully we're going to get her on the podcast in the near future. So that's another exciting thing that's happened this week. And of course, we've got some nice reviews as well, which is always again another positive, which I think you're going to read out a couple of them. We asked for reviews last time and people sent them in, so we said we'd read them out, but Andy's going to run through a couple of them, and each of those people, if they write in, email me, Damien@moneytothemasses.com. We'll make sure you get a Money to the Masses mug. It's been a while since we've given some away.
So here they are then, a couple of reviews. Thanks again for sending these in. So Benny Davis, 5-star review, has said, absolutely excellent, valuable information, which is so helpful for financially progressing in life. We've also got one from Simon Says, fantastic, 5-star review again. Thank you for that. Really look forward to each weekly episode. Very informative and helps me manage and update my portfolio. Let's do one more. This is Andy G, another 5-star review. Outstanding is the title of that one, and Damien provides a succinct, thoughtful and measured analysis. Most insightful. And one of those little clappy emojis.
Everyone loves an emoji.
Yeah, exactly. Right, so that's reviews done. We've had a week off. We loved it. Let's get back into it then. What have we got coming up on this week's show?
So the investing piece I'm going to do this week is related to Bitcoin and gold. So I teased in midweek markets that I would do something, but it's about Bitcoin and why it's creeping into some people's portfolios and why people might be wanting to look at it. But also, even if you're not interested in Bitcoin, but why you might want to keep an eye on the price of Bitcoin, as it gives you some quite valuable information about market trends that are going on in investment markets. Another piece we're going to do is on the government's mortgage guarantee scheme that was announced. And we're going to lead on from that. So it's 95% loan to value mortgages and about buying houses without any deposit. So Laura is coming back to the show. So we mentioned Bronte at the start of the show. We've got Laura, one of our more recent recruits to the Money to the Masses team, who does all of our credit. She's our credit and mortgage editor. She's coming on to do that piece. And finally, I'm going to do something on procrastination and sorting your finances. We had a great email come in I want to read out, but just a few thoughts to close the show off with on that topic.
Okay, so shall we start with Bitcoin then?
Yeah, I mean, this is quite an interesting concept on Bitcoin. Now, Bitcoin, as many people will have read about, is a digital currency that is incredibly volatile when you look at its price. I mean, it's had a lot of headlines to do with bubbles, almost a boom and bust. The way it often trades is very cyclical in almost a boom and bust fashion. And if you go back a couple of years, we saw the price hit about $20,000 and then it crashed down again. And this year it's exploded higher. And as we make this show, it's up around about $54,000, but it has crashed down from like 10-12% in the last week. That shows how volatile it is. And I know there are a lot of people who are excited about it, a lot of people who are scared of it. And what I wanted to do was talk about Bitcoin, but in the context of a wider portfolio, and in particular in relation to gold. Now, gold is something that a lot of people might have exposure to in their portfolios. Indeed, on 80/20 Investor, I've done a piece how you can have a small portion of your portfolio exposed to the gold price, and that can actually help defensively on your portfolio. And there is a certain amount that if you go beyond, and it's just to give you a hint without giving all the research away, if you go above 5 to 10% of your portfolio in gold, it starts to really increase the volatility of your portfolio. But gold and Bitcoin have been an interesting combo in recent months and weeks. So gold traditionally is seen as an inflation hedge. So the idea being that if inflation comes along, then gold if you hold it, it will hold its value. So you put your money in gold, then even if your currency in your pocket is worth less every day, because that's what inflation is, the price of things in the shop go up. So you have to have more pounds to buy whatever it is you're trying to buy. Gold is meant to be an inflation hedge. Now, it's not a perfect inflation hedge by any means. And Bitcoin, as much as people see it as a bit of a speculative asset, it actually, if you look at it, it trades much like gold. It trades much like a share. So you get a lot of spikes of volatility because gold is very volatile in its own right. And if you look at it, there are definite support and resistance lines. So we talk about technical analysis on the podcast from time to time, where if you look at the wiggly line of anything that goes up and down, whether it's a share, whether it's the gold price, there are patterns whereby when the price gets to a certain level, you might get a rush of sellers and it becomes like a resistance line. It then pulls back. There are certain patterns that tend to repeat over time that might give you a hint as to the direction of the asset in future in terms of its price. Now, you see that with Bitcoin. It's not just a random asset doing random things. It behaves in ways that we've seen before. So you can see when it becomes overstretched in terms of its price. Now, Bitcoin and gold share something in common, and that is a limit or a limited supply. Now, Bitcoin by its design is a limited number of Bitcoins that will ultimately be mined, and apparently the amount of gold that's ever been mined from the ground since Egyptian times can fit into 3 swimming pools, 3 Olympic swimming pools. So there is a real finite amount of gold as well. And so that limit on the ultimate supply means that over time it works as a good inflation hedge, because if there's a limit on the supply and then if demand goes up, the price goes up. So you've heard people talk about Bitcoin being a new gold or gold 2.0. So you're seeing, if you look at the price of gold versus the price of Bitcoin. Now, if you ever want to do this, have a look at, if you've got your stock app on your iPhone, if you type in GC equals F, that's the gold price. So you can follow that. And if you type in BTC hyphen USD, that's the price of Bitcoin in US dollars. So you can follow those two, and they're quite interesting to watch the dynamic. And in recent months and weeks, you will see that Bitcoin has been doing very well, and it seems to be at the expense of gold. So there was a view that people are selling out of gold and buying Bitcoin because it's like the new digital version of gold. But if you look at it, there's a much more nuanced dynamic that's going on between them, which is why I come back to when I started this piece on Bitcoin, that Bitcoin is starting to have a place in institutional investors' portfolios. And even as an investor, you might not want anything to do with Bitcoin, but its price can give you some information about what's going on behind the scenes of investment markets. So, like I said, Bitcoin's price tends to go up when gold goes down and vice versa. Of course, it's not a perfect relationship, but that is seemingly what happens. But they are actually fundamentally different, because while gold is seen as an inflation hedge, so when inflation or fears of inflation start to go up, so people think that there is going to be inflation, they might buy gold. But then you might be sitting there looking at recent times, and we've been talking about the reflation trade on midweek markets, and you might be sitting there thinking, yeah, but the price of gold has been going backwards. It's been going down. Why is the price of gold not going up then if it's an inflation hedge? Conversely, during that period, Bitcoin has been doing really well and has been going up. And the reason why this relationship seems to be happening is that gold is a good inflation hedge when real interest rates are actually falling. So gold does badly when real interest rates go up. So if you think about it, a real interest rate is a yield on, say, the 10-year US Treasury bond. So that yield, and if you take away inflation, that will send that yield number negative. So the real yield after inflation taken into account, if that real yield is going up, then that's bad news for gold. And if you think about it, gold is just a golden rock, a lump. It doesn't give you anything. There's no interest. There is no yield. So if the real yields are going up, that makes gold look less attractive. So it doesn't matter that inflation's going up if the real yield is going up. So that means that yields on bonds in particular are shooting up. It makes gold less attractive. Bitcoin, on the other hand, that isn't true. With Bitcoin, it's a risk-on asset. So when people are feeling exuberant, Bitcoin is one of those things that goes up. And that is partly a reflection of what's going on at the moment, that when people are optimistic and they're optimistic, say, about the economy, bonds do badly, because in that environment, similarly to gold, bonds do badly. That's because they're fixed income. If the economy starts to boom, interest rates start to go up, that makes bonds less attractive. So when bonds do badly, that means their price falls, but their yield goes up. If you remember, it's like a seesaw, they work in opposites. So when bond yields rise, that is a sign that people are probably thinking that inflation is going to pick up, but also the economy is likely to do better. That is an environment, if inflation expectations are going up at the same time as yields on bonds, Bitcoin does well. So you can see that in the environment that we've had in the last month, we've had yields on bonds shooting up in the air, but at the same time inflation expectations have been. Well, that's been good for Bitcoin, but it's been bad for gold, despite gold meant to be being an inflation hedge. So what this means is if you look at the price on a given day or a given period of time of Bitcoin and gold and see how they're behaving when one's going up or one's going down, that tells you a lot about what people think in terms of inflation going forward. And in particular, there's an argument to say that if you are trying to hedge inflation, then rather than having just gold or even just Bitcoin, you could have a combination of the two in a portfolio. So your small allocation to what would have been perhaps gold, there are people now and institutional investors who are thinking of having exposure to Bitcoin and gold, perhaps in a ratio of maybe 4-1, in favor of gold. Bitcoin's incredibly volatile, more volatile than gold is. And so they rebalance that periodically. So when you get a period like we've seen now where the price of Bitcoin has gone through the roof and you end up making sort of fourfold of your money in a short period of time, they will then start to rebalance and then maybe buy more gold. If you look at the market in the last week, gold is starting to do quite well. It's starting to pick back up again. There's a potential. People are wondering whether gold's suddenly going to come out of the doldrums it's been in since the summer of 2020 and then go on a run. Now, it's possible if the reasons for that, as I've described, are because people think, well, there's going to be inflation. Yep, that's good for gold. But if we've seen real yields start to fall because the bond yields have started to come back down, then that's good for gold. It might not be so good for Bitcoin. But ultimately, the message of this part of the podcast is that Bitcoin and gold are now starting to creep into more portfolios, but you don't have to be somebody who is a cult member of this whole Bitcoin thing. Bitcoin is another asset type. It's incredibly volatile. You don't want to overexpose yourself to it, but it's starting to find a place in portfolios. But more importantly, if you want nothing to do with it, then you can go and look at the price and how it's moving in relation to gold. And it starts to tell you a bit about what's going on in the background. And I mean, I'll sit there and do it now while I'm doing this podcast. As we record this, it is Thursday. Now, the price of Bitcoin has fallen over 3% today. That's not enormous in terms of Bitcoin, but it's significant. Whereas gold is broadly flat. And that is partly because if I look at the 10-year US Treasury yield, well, what's the 10-year US Treasury yield doing? Again, the Treasury yield has started to come down, so it's in favour of gold. And if you look at the other commodities out there, so you start looking at the price of oil and copper, they are in positive territory. So it shows you there's a bit of an inflation story there as well, because obviously when the price of commodities pick up, that starts to influence inflation, because obviously commodities are used to make stuff. So you can see that I regularly look at the price of Bitcoin because I'm interested in what's going on with gold. And when gold goes down, I'm looking at it and looking at Bitcoin and saying, well, what's Bitcoin doing on the flip side? And it'll be right, okay, at this point in time, as the inflation story goes, I can start to see a narrative. We shouldn't be obsessed with it, but it's just a message out there for people who are fearful of Bitcoin. It's got some uses. Those who like it do understand that it is operating like other assets do, like gold, for example. It's not just this thing that's completely decoupled from the world. It's another asset class whose movements are influenced by things other than just supply and demand, the wider economics, the wider narratives that are out there.
Okay, and so next we're going to be chatting to Laura. And Laura's recently written about the government's 95% mortgage guarantee scheme, and she's come on the show to talk about it today. So Laura, welcome to the show.
Thanks for having me back.
So Laura is our mortgage and credit expert. So if you could give us a brief overview of the new scheme, Laura, and how it works.
So the mortgage guarantee scheme launched this week. It was announced earlier in the year in the budget. And the idea of it is that it's going to open up some of those 95% LTV products again, which had all but disappeared over COVID, and sort of previous to that, the number of them available had really fallen anyway since the financial crisis. So it's good news for first-time buyers. It means that rather than having to save up sort of 10 or 15% as a minimum deposit, there are these products available again, which only require a 5% deposit. So overall, it's good news. The scheme launched, as I say, earlier this week, and it's got 6 lenders who have signed up to it initially. So we have Barclays, HSBC, Lloyds Bank, NatWest and Santander have all come to market with their own products. And we've got Virgin Money are soon going to be doing the same thing later next month. Also, as well as these banks that have signed up to the official government scheme, there are other banks and building societies who have decided to also re-enter the 95% LTV market. So there's just a lot more choice now for first-time buyers looking for that kind of level of deposit.
So just to explain what the lenders get out of it, because obviously the aim of this scheme was to try and kickstart this mortgage market of 95% loan-to-value mortgages. So as you say, there are people who, well, it seems to have worked, because there are lenders who are using the scheme to offer the 95% mortgages. There are lenders who are not using the scheme now who are offering 95% mortgages. But what do the ones get out of it that are on the scheme? Presumably the government's backing part of it.
Yeah, I think lenders overall have got a bit nervy as a result of COVID and sort of just general concerns about taking on too much risk. So what the government scheme aims to do is to incentivise lenders to offer these products again by, in effect, taking on 15% of the risk of the loan. So if that loan defaults, the government will cover 15% of it. So the lender is only taking on the equivalent risk that they would with an 80% LTV product. So it's just taking some of that risk off of the table for lenders. It's interesting to note, though, that lenders are still risk averse. There are much stricter affordability criteria with these products, and actually a lot of them are only available at quite a high APR. So we're looking at around 4% for a lot of these products, which compared to what you could get with a lower LTV is, it is considerably higher.
So the lenders who are on the government scheme, there's no real caveat about the type of house you can buy. But isn't it the case that, like you say, some of the ones that aren't using the scheme, who are just coming to the market now to offer 95% mortgages, are even adding their own caveats on the type of houses that you can actually buy?
Yeah, so with the government scheme, the main limitation is that it's available for properties up to £600,000, and that's for first-time buyers, and that's also for people remortgaging or moving house. It's open to all of those people. In terms of the lenders outside of the scheme, there are some restrictions. Some of them are stating that they won't lend to people buying flats, and there's also a bit of concern, and some are ruling out also lending on new build properties because they're concerned, again, that represents too great a risk in terms of the possibility that the value of those properties is going to depreciate.
So whether you agree with the schemes or not, the point of this piece is that the availability of mortgages when you have a low deposit is actually increasing, which is good news, not just for obviously first-time buyers, but for the wider market. I mean, for people who are trying to get on the property ladder, there's the article from Laura is going to be in the show notes. She does point out the alternatives out there, so schemes like shared ownership and the Help to Buy equity loan, which we link through to some articles, and actually to point out nice circular reference that the Help to Buy equity loan piece was written by Bronte, who has just joined the Money to Message team that I mentioned earlier on in the podcast. So just moving on before we wrap up the mortgage piece, Laura, you also did some research around the 100% mortgage market, whether you can actually get 100% mortgage. That was the thing that really caused problems back in the financial crisis. So where are we with even lower deposit levels?
Yes, I know that there's going to be some listeners out there who are thinking that actually even this 95% LTV and this 5% deposit is still out of reach and might be considering whether they can get a mortgage without any deposit. And I mean, overall, the answer is no, not easily, not a standard mortgage, but there are guarantor mortgages available at 100% LTV. However, with those products, they're specialist. There's quite a lot of risk involved involved to the person acting as the guarantor. So they're not going to be suitable for everyone. It's also worth pointing out that there are some other alternatives. So a kind of subset of guarantor mortgages that are known as family mortgages, and they work by parents or grandparents, step-parents, putting some of their savings into an account that is linked to the mortgage. So it minimises the risk that the guarantor has to take on, but can open up the possibility of buying a property for their children as first-time buyers. And I think we can link to those articles as well in the notes.
Yeah, so just a quick overview. We can do more on guarantor mortgages if people want. If you want us to, we can do it on a future podcast. But as Laura mentioned, they are a very specialist product. And to be honest with you, the risks of the guarantor are significant. So they aren't something you want to enter into lightly. But we're just highlighting that these things exist. And like Laura said, the family mortgage market that exists, there's some products which essentially allow people to have some savings set aside, but what happens, that savings is locked away, can earn interest, but it still works in almost guarantor fashion that if the person, say it was a daughter or son who's buying a house, defaults on the mortgage they've been able to get, because that sum is there in a savings account, then they will actually start to lose some of that money at some point. So thank you, Laura, for coming back on the show. If anybody has any questions regarding mortgages or credit, then you can email in. Laura@moneytothemasses.com is her email address. And if we get enough questions, that we may drag her back onto the show to get her to answer them in full. So do send in your questions. So thank you for coming on the show, Laura.
Thanks for having me.
Okay, so this is about getting stuff done. And Damien, you received some feedback in an email and it inspired this piece, didn't it?
Yeah, I mean, it's great to get people's feedback. And one of the pieces of feedback I had recently, which I'm going to read out anonymously, and it starts with the person saying that they started to adult or adulting in lockdown, which is a term that I've only just recently come across. And they had taken the MOT and looked at improving their finances. And what is great, they listed the highlights of the things that they've achieved. And they said they've tracked their monthly spending to see the wastage. They are now overpaying their mortgage. They've paid off their credit card. They've moved their children's junior ISAs to better funds, and they've started some small investments of their own, and they've even consolidated pensions. Now, they say they're incredibly grateful, and they've started to listen to midweek markets as well, which is also fantastic. And what I wanted to highlight to people is that the MOT obviously exists, and if you haven't done it, go and look at the MOT, go and do it. It's free. It will take you 2 minutes, 12 multiple choice questions which you can answer anonymously. It will give you a grade of your finances and give you star ratings for different areas of your finances, and even give you a position in the wider population of where you stack up. And then you can, if you want to, register for a plan to help you improve individual areas of your finances. And so that will improve your overall MOT score. Now, of course, what it does highlight, though, when I was looking at this piece, is that the most important task you've got to do when it comes to money is the first one. And it doesn't matter about the order necessarily. So there are things that work better in certain orders that, yes, you might want to look at your debt if you've got lots of debt. But the key thing is when it comes to trying to do something and not procrastinate. Now, I am one of the world's worst procrastinators, and I would challenge anybody out there to try and beat me on that one. Andy would vouch for me in terms of procrastinating. I'm one of those guys who distracts everybody else before I'm even doing my own work.
But I must say, in the period of lockdown when everyone was working from home, the work at Money to the Masses went through the roof because Damien wasn't coming in and disturbing us all. Brilliant.
I mean, I've got massively into something called the Pomodoro technique. So if you don't know what it is, Google Pomodoro. I think it's Spanish for the word tomato. It's basically a technique of using timers to work in 25-minute chunks. And what I wanted to highlight from this piece of feedback is that the order of what you're doing doesn't necessarily matter. It's about taking that first step on a journey. And more importantly, when you're trying to achieve anything when it comes to money, and this goes for me in work as well, is to break things down into smaller constituent parts and then try to complete those individually. So I want to give you one example. I've got to now go and do my annual car insurance renewal, a job that I do loathe. But what I do is I will go and follow a series of steps because I will keep putting it off and putting it off. And so I will take one task as even just to get the renewal pack and isolate and find out how much I paid this year and how much I paid last year. That is one task. The next task is that I'm going to then go onto the comparison site that I always use and just update the prices. Then the next task I'm going to do is go through and see where my insurer is on that list of results and see how they compare. And then I'll look at some of the cheapest quotes and compare them to my existing one. And there are lots of individual tasks that it doesn't really matter if you do them in separate days, as long as you do them one by one. And so if you're trying to pay down debt, one of the things is people just see this whole mountain. One of the things is just to go and get all of your credit cards and loans, find all the statements. That's task number one. The next task is then to give you a task to list down the amounts you owe and the interest rates. Don't worry about the ultimate thing you're trying to achieve. If you break down the constituent parts, it's unbelievably addictive once you start doing something, the ticking off and completion. A couple of weeks ago, we did a piece on the podcast where I talked about the different ways of achieving things. And I said about when you look at credit card debt, usually it's the snowball method that's best, but you could actually just pay down your smallest debt first rather than the most expensive one. And it doesn't matter as long as it gets done. And so this idea of trying to break things down into smaller tasks does work. And the MOT takes that principle. But even if you're doing it yourself, you can have multiple tasks and break them down into smaller parts. You may not even have to complete each individual overall objective, i.e. looking at your credit cards or looking at your car insurance in order. You could do some of the tasks in different orders. Now, I do this when I'm working now, and I've worked out that I have a certain times where I can concentrate and work particularly effectively. And to mix it up, I will end up maybe creating content that might be video content or writing articles or researching articles, doing bits for the podcast, all in almost chopped up fashion. I'll do one and then jump onto the other. And so it might take me a day to prep the podcast, but I'm doing it in stages, because if I had to sit down and go, right, I'm going to prep this week's podcast, it could take me a hell of a long time and it seems like quite a big job. Money is exactly the same. So if you're finding you're stuck and you just can't get going, try and break down that task that is stopping you into much smaller ones. So you want to review your mortgage, right? Go and search for a good mortgage advisor, look at reviews on something like Vouched For. Then maybe one of the tasks in it is to go and find your latest mortgage statement or request it, find out the original documentation for that mortgage. There's all those tasks. Write the tasks down and then start ticking them off on the checklist, because some of the tasks you have, and this goes back to when you're effective, one of the theories about productivity and actually completing things is that throughout a given day, you have attention spans that vary. So I'll give me as an example, between 9 and about 11, I'm pretty effective. I'm kind of, you listed it in terms of gold, silver and bronze. In terms of attention span, it's about silver. Anything between about 11 and 1 o'clock, this is bronze territory. I'm not as engaged. Between about 1 and 4 o'clock, that's gold. So you want to give tasks that require a lot of concentration, you do them in those periods. And the ones that are a bit more like rearranging your paper clips, which might be trying to find your statements and stuff like that, you do that when your concentration levels are low. So that might be you do that in an evening when you got back from work and you're tired, rather than having to engage fully with a particular topic, having to research, just find your statements. If you do those when you've got the time and the inclination, and you make sure you keep ticking off little tasks, you'll eventually complete the whole thing. So there's our message for this week. If you're stuck, if you're a procrastinator, then either take our MOT, follow that, or just break down whatever it is into smaller chunks.
I think that's really helpful. And Damien, you taught me a tip about breaking down things into chunks, and where you talked about your gold, your silver and your bronze. We've got a productivity tool that we use in the office, and we can color code things sort of almost like a green, an amber and a red. And I now attribute certain colors to certain tasks based on how long they're going to take me, and I put that into my day based on where I'm most effective, and that really helped. So there's lots of things you can do, isn't there, in these things, tricks and tools that you can use to get this done.
Another good one that I've found is that if you make telephone calls when you're walking, so if you've got to walk somewhere, and rather than you be on hold trying to sort something out and you're going for a walk, you're walking the dog, put your earphones in and put them in and be on hold while you're actually doing something else. And then when they answer the phone, you can then engage with them. Otherwise, you're going to sit there and think, I'm not going to go on hold for 40 minutes to so-and-so, and I've got better things to do. You try and combine the task with other things, and it becomes less of a chore. Listen to podcasts, for example. Do it while you're doing the washing up, or reading articles. Do that while you're on the loo. If you're anything like me, if you've got Crohn's, you spend half your life on the toilet.
Do you know what? I've just had this thought that this very podcast that we're doing now, I wonder how many people are doing the washing up or going to the loo.
We should.
You don't need to let us know.
I was going to say the opposite. I'd quite like to know. I know there's people like Tarquin, who's written in many a time, who listens to things halfway up a mountain. But anyway, I think we're done for this week, Andy. As ever, if people could leave reviews, that would be wonderful. It's incredibly motivating. I'm going to read out another piece of feedback we got just before we went on air that had a wonderful link to Tyson, if I remember next week. Tyson, the boxer, that is. And if you do leave a review, we'll try and read some of them out. And who knows, you may even win a Money to the Masses mug. You can get in touch with me the usual way, Damien at moneytothemasses.com. Follow us on Twitter, Facebook. And I think I've just done your job, Andy, there, haven't I? You normally finish off the podcast. I started and couldn't stop.
That's fine. We've also got a Facebook group, facebook.com/groups/Money to the Masses. I still managed to do something there. There we go. And we're done. Damien, until next time.
Until next time.